Welcome to the Financial Freedom Secrets Show. This is your host, Jackson Millan, the Wealth Mentor, helping business owners create financial freedom faster by mastering the language of money. Want to see how well you're tracking towards financial freedom? Complete our 40-point financial performance scorecard at wealthhealthcheck.com.au. That's wealthhealthcheck.com.au. The average score for most business owners is 18 out of 40. So complete the scorecard now and see how well you're tracking towards financial freedom. G'day guys, this is Jackson Millan, the Wealth Mentor, and we're here for another episode of the Financial Freedom Secrets Show. And we've been going through our series of the signature system of the Wealth Mastery Machine. This is our proven process that we have used to help our clients build over $3 billion in combined wealth. And we're taking you through each aspect of our signature system, providing you with a detailed playbook with a whole set of information and also activities that allow you to apply exactly what we cover in each section of this signature system. Now, this is usually stuff that we reserve for our private clients. But our idea here is that we want to give this to you freely to give you a deeper insight around exactly how we work with our clients. And then, of course, if you need additional support, then reach out to us so that we can help you implement this as well. So if you want to get access to the playbook in this particular episode, where we're going to be talking around magnifying your money. What are the secrets to managing and compounding your wealth so you can get off the hamster wheel? This particular playbook, along with all of our other playbooks, are going to be part of the bonus resources on wealthhealthcheck.com.au. So if you haven't completed the financial performance scorecard, make sure you click the link below, go to wealthhealthcheck.com.au, take 5 minutes to complete the scorecard. It's going to evaluate your profit strategy, your tax strategy, and your wealth strategy, provide you a customized report, and then give you a ton of great resources that'll help you on your journey. So let's get stuck in and work through the new playbook. So, the Magnify Your Money playbook is the 7-figure business owner's guide to the power of compounding. And we've basically been working through over the course of the last few weeks of going through the define piece of the money mindset, the real roadmap, the simple strategy. We finished the create piece of the sustaining surplus, the destroying debt, and the automated investments. And we're now getting to this manage piece where we're talking through the magnify money. And then we're going to follow that up with elevating income and reducing risk. Now, this part is really important, guys, because there are fundamentally different skills between making money, keeping it, and then making it work for you. And we see a lot of people who have great businesses, great profitability, are actually making great wealth. But because they don't understand this management piece, they in many cases end up crystallizing their gains too early, and it actually stifles the growth opportunity they would have had if they would have just stuck the course with the right assets. So the reality is you didn't build a 7-figure business by accident. You worked, you sacrificed, you made decisions that scared you, and you kept going when others quit. But here's the thing about most successful business owners that they never hear. Building wealth and keeping wealth are two completely different skills. I have watched too many business owners pour everything back into their company, or let cash sit idle in a bank account earning next to nothing, or making emotional investment decisions that cost them years of potential progress. So this playbook exists because you deserve better. You deserve a system that works as hard as you do. And you deserve the clarity about where your money goes and what it does and when it gets there. And you deserve to understand the single most powerful force in finance, a force that Einstein supposedly calls the 8th wonder of the world. This is compounding. Let me show you exactly how to put it to work. So, the idea of using this playbook, this is not a book that you just read once and you put it on a shelf. This is a working document. You're going to find exercises throughout. I want you to do them. Write in the margins. Fill out the worksheets. The value is in the doing. Each section builds on the last. Don't skip ahead. Give yourself a solid 2 hours to work through this the first time and then revisit it on a quarterly basis. So, let's get stuck into part 1. So, here is the truth about money that most business owners miss. Chapter 1. Why your money is probably underperforming right now. Here is an uncomfortable truth. Most 7-figure business owners are sitting on stagnant wealth. Not because they're stupid, not because they lack discipline, but because nobody taught them how to manage money differently than they manage their business. So in business, you stay aggressive, you reinvest, you bet on yourself. But wealth building requires a different mindset. It requires patience, it requires systems, and most importantly, it requires understanding how compounding actually works. So let me explain this with a really simple example. If you have $1 million in investable assets at a 4% annual return, in 20 years, you'll have approximately $2.191 million. At an 8% return, in 20 years, you'll have approximately $4.661 million. At a 10% annual return in 20 years, you'll approximately have $6.727 million. Read those numbers again. The difference between 4% and 10% is not a bit more money. It's the difference between being comfortable and being wealthy. It is the difference between hoping your money lasts and knowing that it will. And here's what makes this even more important. You're not starting with nothing. You already have significant assets, which means compounding can work even harder for you than it does for somebody who's starting from zero, but only if you set it up correctly. So let's go through the current reality check. Before we go any further, you need to know where you stand. I want you to answer these questions honestly. No one's going to see this but you. So question 1, what are your total investable assets right now? Include your primary residence and your business equity. Where is your money currently sitting? List each account and the approximate balance. Question 3, what is the average return you earned on these assets last year? If you don't know, I want you to write down, I don't know. This tells you something really important. Question 4, how much of your wealth is sitting in cash or low interest accounts earning less than 3%? Question 5, when was the last time you reviewed your wealth allocation with a clear strategy in mind? So here's what your answers reveal. If you couldn't answer question 3, you're flying blind. You cannot optimize what you cannot measure. If more than 20% of your investable wealth sits in cash earning under 3%, you are losing money to inflation every single day. If you have not reviewed your allocation in over 12 months, your wealth is almost certainly misaligned with your current life stage and your goals. Now, don't feel bad about any of this. Like, awareness is the first step. Now we need to work out how we fix it. So part 2 is the bucket system. Chapter 2 is the simple framework that changes everything. I'm going to teach you a system that will transform how you think about your money. It's called the bucket system. And it works because it matches how life actually works. Think about it. You have short-term needs, you have medium-term goals, and you have long-term dreams. Why would you manage all of your money the same way? You wouldn't. The bucket strategy divides your wealth into 3 distinct categories. Each bucket has a specific job, a specific time frame, and specific types of investments that belong there. When you get this right, something powerful happens. You stop worrying about market volatility because your short-term needs are protected. You stop making emotional decisions because you have a clear system to follow. And you start experiencing the full power of compounding because your long-term money stays invested long-term. So let me break down each bucket. Bucket number 1 is cash. This is short-term. This is 0 to 2 years. The job is to keep you secure and liquid. So what goes here? Emergency fund, day-to-day operating cash, money for purchases planned in the next 12 months, and ideally we have this in offset accounts against your debt wherever possible. The target amount is 3 to 6 months of living expenses plus any major purchases that are planned in the next 2 years. The expected return is low, but that's okay. Now, why this matters? This bucket is not about growth. It's about peace of mind. When you know your immediate needs are covered, you stop making panic decisions with your long-term investments. Like, I've seen so many business owners sell shares at the worst possible moment because they needed cash and had not planned ahead. That single mistake can cost years of compounding. Your cash bucket prevents that. The mistake that most business owners make is keeping too much in here. Every dollar in your cash bucket beyond what you need is a dollar that's not compounding in your growth bucket. So bucket number 2 is our income bucket. This is medium term. This is 2 to 7 years. The job is to pay you to live without touching your growth assets. So what goes in here? Dividend paying shares, rental property income, primarily commercial property, bond investments, annuities, other income producing assets. So the target amount is we want to work towards covering your lifestyle for the next 2 to 7 years if needed. So the returns are moderate with an emphasis on reliable income. For example, we can go and buy a commercial property that pays us 6% net. We can go set up a portfolio of blue chip stocks that pay us 6% fully franked dividends, meaning that when we gross this up, it's like 7 or 8%. Focus areas: sustainability of income, tax effectiveness, and low volatility. Why this matters? This is your financial freedom runway. When your income bucket generates enough to cover your living expenses, you have options. You can choose to work, you can choose to take risks in your business, you can weather downturns without stress. The income bucket buys you time, and time is the most valuable asset that you have. The mistake that most business owners make is ignoring this bucket entirely. They go straight from cash to aggressive growth investments with nothing in between. Then, when they need income, they are forced to sell growth assets at whatever price the market offers. We're going to talk more about this shortly. Bucket 3, growth. Long-term bucket, 7+ years. So the job is to compound your wealth for the future. So what goes here? Growth shares, property for capital gain, managed funds, superannuation, other long-term growth assets. Target amount, everything else. Expected return, highest potential, obviously within your risk profile. The strategy is to maximize after-tax growth and reinvest all of the earnings. We want capital growth because we don't pay tax on unrealized gains. So why this matters? This is where compounding does its magic. But here's the key. This bucket only works if you leave it alone. Every time you dip into your growth bucket for your short-term needs, you reset the compounding clock. You interrupt the process. You cost yourself years of future returns. This is why the other two buckets exist. They protect this one. So the mistake that most business owners make is they treat growth investments like a savings account, pulling money out when they see an opportunity or face an unexpected expense. Each withdrawal destroys years of potential compounding. So, activity number 2, map your current buckets. Now it's your turn. Take the assets you listed in activity 1 and then sort them into the 3 buckets. So, our cash bucket, that's 0 to 2 years. What are the assets? What are the values? What's the total amount you've got in that bucket? Income bucket, the year 2 to 7 money. What's the asset? What's the current value? What's the income that it generates? What's the income bucket total? And then what's the annual income generated? Growth bucket is 7+ year money. What are the assets? What are the current values? What's the growth bucket total? So activity 3 is identifying the gaps. Look at the bucket totals and answer these questions. Do you have 3 to 12 months of expenses in your cash bucket? If no, how much more would you need to add to get there? Question 2, does your income bucket generate enough to cover your basic lifestyle for 2+ years if needed? If no, what is the gap per year? Question 3, what percentage of your total wealth is in the growth bucket? And then question 4, looking at your answers, which bucket needs the most attention? Great. So let's go on to part 3, the power of compounding. Why time is your greatest asset. Now, let me tell you something that would change how you think about every financial decision. The difference between wealthy and very wealthy is not how much you earn, it is how long you let compounding work. So here's a real example. 2 investors, both invest $500,000, both earn 8% annually. Investor A leaves their money alone for 10 years. The result is $1,079,000. Investor B leaves their money alone for 20 years. The result is $2.33 million. Investor B didn't work harder. They didn't earn a higher return. They didn't earn more money. They simply gave compounding more time to work. So here's what makes this even more powerful. The gains accelerate. So in years 1 to 10, Investor B grew their money by $579,000. But in years 11 to 20, it grew by $1.251 million. It's the same investment, it's the same return rate, but the second decade produced more than double the amount of growth in the first. This is the exponential nature of compounding, and most people never experience it because they interrupt the process. So here are the 3 compounding killers. If compounding is so powerful, then why doesn't everyone benefit from it? Because 3 things kill compounding before it can do its work. Killer 1, withdrawing too early. Every dollar you pull from your growth bucket is not just $1 lost, it's that dollar plus all of the future growth that dollar would have generated. So for example, a $50,000 withdrawal today could cost you $200,000 or more in 20 years. This is why your cash and income buckets matter so much. They protect your growth bucket from early withdrawals. Killer 2, paying unnecessary taxes. Taxes are a compounding killer because they take money out of the system. So if you earn 10%, but you pay 3% in taxes, your effective return is 7%. Over 20 years, the difference is enormous. Smart tax planning is not about cheating the system, but it's about using legal structures to keep more of your money compounding. Killer 3, emotional decisions. Markets go up, markets go down. This is normal. But when business owners panic during downturns and sell their growth assets, they lock in losses and miss the recovery. The data is clear. Just missing 10 days in the market over a 20-year period can cut your returns in half. Your growth bucket system protects you from the emotional decisions by ensuring that you never need to sell your growth assets in a downturn. So let's go through activity 4. Calculate your compounding potential. Let's make this personal. Write down your current growth bucket total from activity 2. Now, assume an 8% return. Calculate what this could become in 10 years. So multiply it by 2.16. In 20 years, multiply it by 4.66. In 30 years, multiply it by 10.06. Now, add the monthly contributions you plan to make to the growth bucket. So whatever that might be, let's say it's $1,000. Let's work out the annual contribution and then factor your contributions in this rough guide. So $5,000 a month for 20 years at 8% is approximately $2.945 million in contributions plus growth. 10,000 is 5.8, 20,000 is almost $12 million. So then work out your projected growth bucket in 20 years. What's the current amount compounded plus the contributions compounded, and this is the total potential. Write this number somewhere that you will see it daily, because this is not a fantasy, this is mathematics. The only question is whether you will allow compounding to do its work or whether you're going to interrupt it. So let's get into part 4. The income trap. Why chasing cash flow too early destroys your wealth. So let me tell you about a really expensive mistake I see 7-figure business owners make. They chase income too early. It feels logical. You want passive income. You want cash flow. You want your money hitting your account every month. So you load up on dividend shares, rental properties, income producing assets. And you feel good watching that money roll in. But here is what nobody tells you. Every dollar of income you receive is a dollar the tax office takes a cut of immediately before you can reinvest it, before compounding can work on it. And that cut is brutal. At the top marginal tax rate, you lose 47 cents of the dollar. Let's let that sink in. For every $100 of income that your investments produce, you keep $53. The government takes $47. Now compare that to capital growth. Unrealized capital gains are taxed at exactly 0%. Not a reduced rate, not a concessional rate, 0. The money stays in your investment, it compounds, it grows year after year, untouched by the tax office until you choose to sell. Now that's not a small difference. This is a difference between comfortable and wealthy, and let me prove it. So, the numbers that should change how you think. I ran a detailed 20-year projection, the same starting investment, the same total return, but just a different split between income and growth. So the starting value was $1 million. The growth return was 5% per year, unrealized capital gain. The income return was 3% per year, dividends or distributions. The tax rate was 47%. The capital gains tax rate was 24.5% after the 50% CGT discount was applied, and all net income reinvested was 100%. Here's what happened over 20 years. You earn 30 grand in income. In year 1, you pay $14,100 in tax. You keep $15,900 to reinvest. Your capital grows by $50,000 untaxed. The end value is $1,065,000. Year 10, your income's grown to $53,000. You pay $25,000 in tax. $28,000 you reinvest. Your capital grows by $88,000, still untaxed. The end value is $1.893 million. Year 20, your income's grown to 100 grand. You pay $47,000 in tax. You keep $53,000 in tax. Your capital grows $168,000, still untaxed. The end value is $3.583 million. Now here's where it gets interesting. The 20-year totals. Total gross income received, $1.176 million. Total income tax paid, $552,000. Net income after tax, $623,000. Total capital growth, $1.96 million. Capital gains tax if sold, $480,000. So the net capital after CGT is $1.48 million. Read those numbers carefully. You paid $552,000 in income tax over 20 years. That money left your investment, gone, never to compound again. But your capital gains tax, you only pay that if you sell. And you only pay $480,000 on nearly double the amount of gains. The effective tax rate on income, 47%. The effective tax rate on your growth, 24.5%. That's not a small edge. That's a massive structural advantage. So chapter 6, the hidden cost nobody talks about. But wait, the damage is even worse than those numbers show. Every dollar you paid in income tax was a dollar that could have been compounding. So that $14,100 paid in year 1 at 8% over the remaining 19 years could have grown to $59,788. That $15,000 you paid in year 2 at 8% over 18 years could have grown to $60,000. All adding up to the lost compounding on your tax payment, the true cost is staggering. You did not lose $552,000 in tax payments. You lost $552,000 plus all of the growth that money would have generated. The real cost is closer to $1 million in lost wealth from the same investment. with the same total return, just a different structure. The tax office gets paid. The question is when. So here is the thing. I'm not saying you will never pay tax on capital growth. You will eventually when you sell, but you control when, and timing is everything. With income, you pay tax every single year at your highest marginal rate, obviously assuming that you're a high income earner earning over $190,000 a year. You don't have a choice, no control. With capital growth, you decide which year to sell, how much to sell, and whether to sell at all. The control is worth millions over a lifetime. So the rule of 72 applied to tax drag. Here's a simple way to understand the impact. The rule of 72 tells you how long it takes for your money to double. So at an 8% return, money doubles every 9 years. But that is before tax. If you pay 47% tax on your return every year, your after-tax return is only 4.24%. At 4.24%, it takes 17 years for your money to double. Same investment, same pre-tax return, but income investors wait nearly twice as long for their money to double. This is an invisible tax drag. It compounds against you every year. Growth investors avoid this entirely until they sell. So let's go through the activity. Calculate your tax drag. List all of your income producing investments and their annual income. So work that out and then put the total annual income tax on your investments. 2, calculate 20-year cost of the tax drag. So annual tax multiplied by 40. It's a rough multiplier for lost compounding. This is the approximate amount of tax drag that will cost you over 20 years. Now, ask yourself honestly, do I need the income right now? Yes or no? Or could I restructure towards growth and reduce this drag? Because here's the thing. If you're in your business, you've got no intentions to retire anytime soon, and the passive income you're producing is just going to pay tax and then reinvest it, it doesn't make a lot of sense. Now, when does income make sense and when it does not? I'm not saying income investments are always wrong. They make sense when you need cash flow to live, no other income sources. You're in the preserving stage, so you're 55 plus, you're protecting wealth. You're in a lower tax bracket, so there's minimal tax drag. Or the income is tax advantage, so it's franking credits, it's depreciation, or it's inside superannuation. They do not make sense when you are still in your high earning years, when you do not need the income to live, when you are reinvesting 100% of the income anyway, or you have 10 plus years until you need the money. My rule of thumb, if you're reinvesting the income, you should not be receiving the income. Like, it sounds obvious when you say it out aloud, but most people never think about it. Why take the income, pay 47% tax, and reinvest the remaining 53%? When you could take growth, pay 0% tax while it compounds, and access it later at 24.5%. The math does not lie. So, activity 6, the income audit. Go through your current investments and answer these questions. How much investment income did I receive last year? How much of that income did I reinvest? I didn't spend on living. What tax rate did I pay on that income? And if you reinvested more than 50% of your investment income, calculate what you lost. Income reinvested, tax paid on that income, lost to tax drag. And question 5, could this money have been structured for growth instead? Chapter 8, the franking credit exception. Now, one quick note for Australian investors. Franking credits change the math somewhat. So when you receive fully franked dividends, you get a tax credit for the corporate tax already paid. This reduces your effective tax rate on that income. So for a top marginal rate taxpayer receiving fully franked dividends, let's say a gross dividend is $100, the franking credit's $42.86, that's 30%. That's a grossed up income of $142.86. Tax at 47% is $67.14. Less the franking credit means that you only have to pay $24.28. So your effective tax rate on the franked dividends is 24.28%. It is much closer to the CGT rate of 24.5%. So, fully franked Australian dividends are less penalised than other income, but here is the catch. You still have to pay that tax every year. It still leaves your investment, it still cannot compound. Even at 24.28%, you are losing a quarter of your returns to tax annually. So, growth investments pay nothing until you sell. The structure advantage still remains. So the growth first strategy. Here's how to think about this strategically. Phase 1, accumulation. Still working, high income. Priority. Try and get as much money into growth as possible. Do not take income if you don't need it. Let everything compound untaxed. Use your employment or business income to fund your lifestyle and keep investment growth sheltered from tax. Phase 2, transition, approaching retirement. Start building the income runway. Gradually shift some assets to income producing investments. Build your income bucket when you need it. Time this shift for the years when your marginal rate is starting to lower. And then phase 3, distribution, retired or living off your investments. Priority is income plus preservation. Now, income makes sense. You need to live, and ideally your tax rate is lower. Draw down strategically to minimize the lifetime tax. The mistake is jumping to phase 3 while you're still at phase 1 life. So, activity 7, structure, your growth first plan. What phase are you in? Are you accumulation, transition, or distribution? Based on your phase, what percentage of your investments should be growth focused? Step 3, what percentage of your investments are currently growth focused, and what is the gap? Now, step 5, list the specific changes that you should shift towards growth. Activity 8, model your scenarios. So work with your financial advisor to model these scenarios. So scenario A, your current structure, your current investment mix, projected 20-year outcome, and the lifetime tax paid. Scenario B, income heavy structure, 80% income investments, 20% growth, projected 20% outcome, lifetime tax paid. And then a growth heavy structure, 20% income, 80% growth, projected over 20 years, lifetime tax paid. Bring this to your advisor meeting and have them run the numbers. The difference will really surprise you. So here are the key takeouts. Unrealized gains are taxed at 0. Income is taxed up to 47% every year. CGT discount reduces the eventual tax to 24.5%. Tax drag destroys compounding over time. Reinvesting after-tax income is inefficient. Growth first strategy maximizes long-term wealth. And shift to income only when you need the cash flow. Part 5. Time in the market beats timing the market. This is the research that proves it. Now, I know what you're thinking. Sure, compounding sounds great, but what if I invest at the wrong time? What if the market crashes right after I put my money in? Now, that's a fair question. Let me show you research that'll change how you think about everything. So, Charles Schwab conducted a study called Does Market Timing Work? Through their Center for Financial Research. They looked at 20 years of market data and created 5 hypothetical investors. Each investor received $2,000 at the beginning of every year for 20 years. Same amount, same time frame, different strategies. Here's what they did. So, Peter Perfect had supernatural timing abilities. He invested his $2,000 on the lowest closing price of each year. Perfect timing every single year. Ashley Action did not try and time anything. She invested $2,000 immediately on the first trading day of every year. No analysis, no waiting. Matthew Monthly spread his investments across the year. He invested $167 per month through dollar cost averaging. Rosie Rotten had the worst luck imaginable. She invested her $2,000 on the highest closing day price of every single year, the absolute worst day. And Larry Linger never invested at all. He kept his money in treasury bills because he was always waiting for the right time. So 20 years, $40,000 total invested, 5 different strategies. Here are the results. Peter Perfect had $151,391. Ashley Action had $135,471. Matthew Monthly had $134,856. Rosie Rotten, worst timing, was $121,171. And Larry Linger had only $44,000. Read those numbers again. It just goes to show the real insignificant impact of perfect market timing to getting it really, really bad. But the contrast to all of those 4 scenarios to keeping your money in cash. So let's break this down. Perfect timing is not worth much. Peter Perfect, with his supernatural ability to pick the exact bottom, only beat Ashley Action by 15 grand over 20 years. That's less than $800 per year advantage for perfect timing. And nobody has perfect timing. Finding 2. Even terrible timing beats not investing. Rosie Rotten invested at the worst possible moment every single year for 2 decades. The absolute peak every time. Still ended up with $121,000, nearly 3 times her original investment. Even the worst timer in history still built significant wealth by staying invested. Finding 3. Cash is the real risk. Larry Linger kept his money safe in treasury bills. He was waiting for the right moment. His money just grew from $40,000 to $44,000, a pathetic $4,400 gain over 20 years. Meanwhile, even Rosie Rotten made $81,000. The difference between the worst timing and no timing is $76,000. Staying in cash lost Larry nearly $77,000 compared to the worst market timer in the study. Finding 4. The gap between the best and the worst is smaller than we think. The spread between Peter Perfect and Rosie Rotten was only $30,000. That's the entire range, from supernatural timing to terrible timing over 20 years. Meanwhile, the spread between Rosie Rotten and Larry Linger was 76,000. Penalty for bad timing is 30,000. Penalty for not investing is 76,000. Which risk is actually bigger? So chapter 11, why this matters for your wealth. Here's what the research means for you as a 7-figure business owner. Stop waiting for the perfect moment. There is no perfect moment. Even if there were, the advantages are small, minimal, compared to simply being invested. Every day you hold cash waiting for a pullback, you're paying a cost, and that cost is lost compounding. Stop beating yourself up over market timing. Bought before the dip, doesn't matter long term. Missed the bottom, doesn't matter long term. What matters is that you invested, period. Understanding where the real risk is. Most people think the risk is investing at the wrong time, but the data shows the real risk is not investing at all. Cash feels safe, but cash is still the most expensive choice that you can make. Trust the system over your instincts. Your bucket system exists to remove emotion from the equation. Cash bucket keeps you liquid for short-term needs. Income bucket provides stability and runway. Growth bucket stays invested through all market conditions. When you have the first two buckets funded, you never need to panic about the third. You can let compounding work without interruption. So, activity 9. Let's calculate your cost of waiting. Let's make this personal. How much investable cash are you currently holding outside of your cash bucket target? So the excess cash waiting to be invested. How long have you been waiting for the right time to invest this money? Months waiting. Calculate the opportunity cost. Excess cash multiplied by an 8% return multiplied by the months waiting. So months waiting divided by 12 will work out the money. This is approximately what your hesitation has cost you so far. If you wait another 12 months, what will it cost? Excess cash multiplied by 8%. What would Rosie Rotten do? Even the worst timing in history, Rosie invested immediately and tripled her money. What is stopping you from doing the same? So, activity 10, your investment action plan. Based on the research, here is what to do with the money waiting to be invested. Option A, invest it immediately. Do the Ashley action approach. Best for lump sums, people who can handle that short-term volatility. Action, invest the full amount on the next trading day. Benefit, maximum time in market, simplest approach. Or option B, dollar cost averaging, the monthly Matthew approach. Best for people who are anxious about short-term drops, regular income. Divide the amount by 6 or 12 and invest it monthly. The benefit is psychological comfort and it reduces regret. Or option C, you keep waiting, Larry Linger. Best for nobody. You hold cash indefinitely. The cost was $76,000 per $40,000 over 20 years versus even the worst timer. So work out your choice. How much are you going to invest, by when, and to which investments? Chapter 12, the psychology of staying invested. Now, knowing the data is one thing and acting on it is another. Here is why most people struggle to stay invested and how to overcome it. So problem 1 is loss aversion. Humans feel losses twice as intensely as gains. A 10% drop feels devastating. A 10% gain feels nice, but it's not proportionately exciting. So, solution, do not check your growth bucket frequently. Quarterly at most. Daily monitoring creates unnecessary anxiety. Problem 2, recency bias. We overweight recent events. If the market dropped last week, we assume it will keep dropping. If it rose, we assume it will keep rising. Solution, remember the Schwab study, 20 years of data. The long-term trend is up, regardless of short-term moves. Problem 3 is action bias. Business owners are trained to act, fix problems, to make things happen. But with investing, action often destroys value. The best investors do very little. So the solution is channel your action bias into your business, not your investments. Your growth bucket performs best when you leave it alone. Problem 4, the narrative fallacy. We love stories that explain market moves. Market dropped because, insert news event. These stories feel explanatory, but have no predictive power. Solution, ignore financial news. It is entertainment, it's not investment advice. The Schwab study did not ask what the news was each year. It showed up and invested. Activity 11, build your staying invested system. Create rules that will keep you invested through volatility. So, rule 1, my review frequency. I will check my growth bucket performance when? Ideally, quarterly or annually. Rule 2, my non-negotiables. I will not sell my growth bucket assets unless 1, 2, or 3. Rule 3, my volatility plan. When markets drop 20% or more, I will. Suggestion, do nothing or buy more if cash is available. Rule 4, my accountability. The person who will stop me from making emotional decisions is ideally a financial advisor or somebody qualified or experienced to hold you to the plan. Rule 5, my reminder, write this somewhere visible. Even the worst market timer in history nearly tripled their money. Time in the market beats timing the market. Key takeaways. Time in the market. Perfect timing only adds marginal returns. Even the worst timer beats staying in cash by 3 times. The penalty for bad timing is small. The penalty for not investing is massive. Cash feels safe, but it costs you wealth. Set rules to stay invested through volatility. Stop watching the news. Start trusting the system. Part 6, building your system. Allocation based on life stage. Now, you understand the buckets, the power of compounding, the income trap, and the importance of staying invested. Let's talk about allocation. The right allocation depends on where you are in your life. So if you're building, you're under 45, you're still growing wealth. Your primary goal should be growth. You have time on your side. So the typical suggested allocation is 10 to 15% in cash, 10 to 20% in income bucket, and then 65 to 80% in the growth bucket. Focus, maximize contributions to the growth bucket. Tolerate volatility, reinvest everything, avoid income producing assets that are less tax advantaged. If you're transitioning, so 45 to 55, shifting towards independence, your primary goal is building your runway to financial freedom. So the allocation, cash, 10 to 15%, income 25 to 30%, and the growth bucket, 50 to 65%. Build your income bucket to cover your lifestyle expenses, maintain growth for the long-term security, start thinking about tax-effective drawdown strategies. And if you are preserving, so 55 plus, protecting and using your wealth, your primary focus is security and sustainable income. So the cash bucket should be 15 to 25%, the income bucket should be 35 to 50%, and the growth bucket should be 30 to 45%. The focus is to ensure reliable income, to protect against major downturns, and to maintain some growth to outpace inflation. So, activity 12, define your allocation. Based on your life stages above, what allocation would make sense for you? What's your target cash bucket? What's your target income bucket? What's your target growth bucket? Step 2, convert to dollar amounts using your total investable wealth. So, your total investable wealth, what's the dollar amount for the cash, income, and growth bucket? Compare this to your current buckets from activity 2. What needs to change? Now, chapter 14, monthly contributions and rebalancing. So, getting your allocations right is step 1, keeping it right is step 2. So, monthly contributions. Every month, you should be adding to your buckets based on your target allocation. If you're in the building stage, most of your contributions go to growth. Transitioning should be split between income and growth, and preserving should be focusing on income with some cash. The key is automation. Set up automatic transfers so you do not have to think about it. Decision fatigue is real. Remove the decision. And annual rebalancing. Once a year, review your bucket allocations. Markets move. Your growth bucket might have grown faster than the others, shifting your percentages. Rebalancing means you sell some of what's grown to buy more of what hasn't. This might seem counterintuitive, but it forces discipline in buying low and selling high. Schedule your annual review. Put it in your calendar right now. So life event triggers. Some events should trigger an immediate review. So sale of a business or a major asset, inheritance or windfall, major purchase or property, change in employment or income, health diagnosis, family changes, marriage, divorce, children. When life changes, your buckets should change with it. So activity 13 is build your contribution plan. How much surplus income do you have each month after expenses? Step 2. Based on your life stage and your target allocation, how will you split your monthly contributions? Cash, income, and growth bucket. When will you do your annual rebalancing review? And ideally do this with a financial advisor. Step 4, list any upcoming life events that should trigger a review. So, part 7, making it real. This is your 90-day action plan. So, knowledge without action is worthless. Here's what I want you to do over the next 90 days. In the first week, complete this playbook. Finish the activities, calculate your current bucket allocations, define your target allocations, identify your gaps. Week 2, schedule professional reviews. Book a meeting with your financial advisor, bring this playbook with completed activities, review your bucket allocations together, get specific recommendations, model the growth versus the income scenarios. Week 3 and 4, implement quick wins. Move excess cash from low interest accounts, consolidate scattered investments, set up automated contributions, eliminate unnecessary fees, restructure income heavy investments towards growth. Month 2, restructure as needed. Execute recommendations from your advisor. Rebalance towards your target allocation. Update beneficiary information. Review insurance coverage. Implement tax effective structures. Month 3, systematize and monitor. Set up a tracking dashboard. Schedule quarterly check-ins. Create rebalancing triggers. Document your system for reference. Set rules for staying invested through volatility. So activity 14, your personal action items. So work out what this week I will do what. This month I will do what. In 90 days I will have what. Who is going to help me? If you don't have a qualified financial advisor to support you, you are leaving opportunities on the table. So part 8, the mindset shift. Think like a wealth builder. I want to leave you with something that goes beyond tactics. Like building wealth as a business owner requires a mindset shift. In your business, you are used to action, making things happen, forcing results through effort. Wealth building is different. The best thing that you can do for your growth bucket is nothing. Leave it alone. Let compounding work. Do not check it every day. Do not react to headlines. Do not tinker. This is hard for action-oriented people, but it is the truth. Your job is to set up the system correctly, fund it consistently, and get out of the way. The money does the work. You just have to let it. So this is the long game. Here are my final thoughts for you. You build a 7-figure business that puts you in rare company. But the businesses that seem so permanent today will eventually change, sell, or end. Your wealth system can outlast any business. It can provide you with opportunities and your family for opportunities for generations. It can fund causes that you care about. It can give you freedom that no business ever could. But only if you build it intentionally. Only if you respect the power of compounding. Only if you think in decades, not months. You have the resources. You have the intelligence. You have this playbook. Now go build something that lasts. So this is general advice and doesn't take into account your personal circumstances. So make sure that you do seek professional advice before you take action. And if you want to get access to this guide, along with all of our other playbooks and resources, go to complete the financial performance scorecard at wealthhealthcheck.com.au. Get a customized report that will show you your strategy across profit, tax, and wealth, and show you exactly where you should be focusing your attention. Now, if you want to join us for the next episode, we're going to be going through the Elevate income of how do we actually start transitioning towards passive income so we've got the ability to choose what we do with our time. This has been another episode of the Financial Freedom Secrets Show, and we'll catch you next time.